Welcome to the Deep Dive. Today, we're plunging headfirst into the high-stakes world of biotech.
Yep.
We're shining a spotlight on Sagimet Biosciences Inc., trading on NASDAQ under the ticker SGMT.
SGMT, right.
This company is really at a pivotal moment. It can be a monumental breakthrough or, as often happens in this industry.
Another promising candidate that just doesn't quite make it across the finish line. It's a tough field.
Exactly. As of June 20, 2025, SGMT closed at $8.72. Our mission, as always, is to cut through the noise, pull out the most important bits of knowledge from the public research.
And give you that shortcut to being truly well-informed on what's going on here.
It's a fascinating situation, really, kind of a high-wire act.
It absolutely is. The data, well, it hints at massive potential upside, but the challenges, they're equally formidable.
So it's that classic high-risk, high-reward play we see in biotech.
Totally. It really hinges on whether you believe their lead drug can actually succeed. That's the core tension.
Okay, so that's why we've structured this deep dive into two main parts.
Makes
In part one, we'll lay the foundation. We'll explore Sagimet's Chapter 1, business understanding, then move to Chapter 2, management evaluation, and finish part 1 with Chapter 3, financial analysis.
Got it. Business, management, money, the basics.
Then in part 2, we'll zoom out a bit.
Yeah.
We'll look at Chapter 4, market sentiment, Chapter 5, ownership structure, Chapter 6, risk assessment, and then wrap everything up in our Chapter 7, conclusion.
Sounds like a good plan. It's a complex landscape, but we'll navigate it.
Absolutely. And hey, before we really dive in, just a quick reminder for everyone listening.
Oh, dear. Good point.
Remember to like and subscribe to the Stock Analytics AI YouTube channel. Members, it's just $4.99 a month. You get priority deep dives on tickers you request.
And we've got a big project coming up, too.
That's right. Over the next few months, we're covering all of the S&P 500 stocks, exclusively for our members. Okay, let's get into it.
Let's do it.
Chapter 1, Business Understanding. So what exactly does Sagimet Biosciences do? How does a company like this operate in such a risky sector?
Well, Sagimet runs on a pretty typical model for a clinical stage biopharma company. They're not selling approved drugs yet, right?
Right, pre-revenue mostly.
Exactly. They're basically in the business of taking capital, mostly from selling stock.
Equity offering.
Yeah, equity offerings, and turning that money into scientific data through clinical trials. The whole goal is to prove a drug works and is safe, de-risk it so regulators will approve it.
And their only real product-related revenue so far was that $2 million payment.
That's right, a $2.0 million strategic licensing payment back in 2023. It came from Ascletis Bioscience.
Ascletis. What was that for?
That was for the rights to develop denifanstat, their lead drug, over in Greater China.
Okay, so that $2 million isn't just a random revenue blip then. It sounds strategic.
Oh, it's a huge signal, actually. It's not just revenue, it's validation. Ascletis is betting real money on denifanstat's potential in a major market.
Right, gives them cash without selling more stock, too. Non-dilutive funding.
Precisely. And it shows that another company, presumably one that did its homework, believes in the science. That kind of partnership is golden in early-stage biotech. Spreads the risk, provides validation.
Okay, so let's talk about denifanstat. That's the lead candidate, the main event here.
Yes, denifanstat is absolutely the centerpiece. It's an oral, once-a-day pill. It's what they call a FASN inhibitor.
FASN, fatty acid synthase.
You got it. Fatty acid synthase inhibitor. And its main target is
MSH, okay? Metabolic dysfunction-associated steatohepatitis. That's the serious liver disease, right?
Yeah.
Huge unmet need there.
Huge. Virtually no approved treatments in Europe, and only one just recently approved in the U.S. So the field is wide open.
And what makes denifanstat different? What's its angle?
Its mechanism. It specifically targets the overproduction of fat in the liver, so it tackles the fat accumulation, the steatosis, but also the inflammation and the fibrosis, the scarring. It's a different approach than many other drugs being tested.
And the news flow around it has been pretty good lately, especially on the regulatory side.
Incredibly positive, yeah. It had that successful, pivotal Phase 2b trial. They called it Fascinate-2.
Fascinate-2b, right.
And then the big one, it got breakthrough therapy designation from the FDA. That was back in October 2024.
Specifically for MS patients with F2 or F3 fibrosis.
Correct. The moderate to advanced fibrosis stages.
So for listeners maybe not deep in biotech jargon, what does breakthrough therapy actually mean in practice? Is it just a nice label?
Oh, it's much more than a label. It's the FDA basically saying, hey, we think this drug could be a substantial improvement over anything else available for a serious condition.
So it signals real confidence from the regulator.
Exactly. And it comes with Perks, more intensive FDA guidance, potentially eligibility for accelerated approval, priority review. It can really speed up the whole development process. It's a tangible asset.
Okay. And is Sagimet just about denifanstat for MSH, or is there more in the pipeline?
There's a bit more. They have another FASN inhibitor, TVB-3567.
TV3567. Different target.
Yeah, this one's for moderate to severe acne. It actually just got IND clearance, that's the green light, to start human trials back in March 2025 for a phase 1 study.
Interesting. Acne. Targeting sebum production, I guess.
That's the idea, yeah. Hitting that FASN pathway again. And looking even broader, they are exploring the potential of their FASN platform in oncology, too.
Oncology. Like cancer.
Specifically aggressive brain cancers like glioblastoma or GBM, so, it's not entirely a one-trick pony, which helps spread the risk a little.
Good point. So wrapping up the business model, Sagimet is a small-cap biotech. Market cap around $266 million as of late June 2025.
Tiny compared to some competitors we'll talk about.
Right. No real market share yet. They're an innovator, trying to be a first mover, or at least an early mover, with a differentiated approach in this massive MAH market.
Their value proposition is all about that potential, isn't it? A new, convenient, hopefully effective oral pill for these complex diseases with huge unmet needs.
Okay, let's shift to that bigger picture now. The industry. How big is this MAH market really, and who else is playing in this sandbox?
The MAH's market potential is just staggering. We're talking over 115 million adults affected worldwide.
Wow.
And the forecasts, explosive growth from maybe $7.7 billion in 2024 projected to over $90 billion by 2034.
$90 billion. That's a compound annual growth rate of like 28%.
Exactly. It's massive. That recent first U.S. approval, Madrigal's drug, kind of validates the whole space, but the unmet need globally is still immense.
And the market for FASN inhibitors specifically?
That's much smaller, obviously, still nascent, valued around $357 million in 2024, projected to grow, maybe hitting close to $577 million by 2030. If Sagimet succeeds, it could really validate and grow that whole class.
Okay, but it's not alone. The competition sounds intense.
Oh, it's incredibly intense and fast-moving. You've got other small biotechs, but also the big pharma giants circling.
Who are the main late-stage MAH competitors we should know about?
Okay, key names. Madrigal Pharmaceuticals, ticker MDGL. They got Rezdiffra approved, first MSH drug in the U.S. Their market cap, $6.5 billion.
$6.5 billion versus Sagimet's $266 million.
Right. Then there's Acro Therapeutics, AKRO, phase 3 drug, $4.3 billion market cap. 89D-Alio, ETNB, also phase 3, $1.5 billion. Viking Therapeutics, VKTX, phase 2B, but still $2.9 billion market cap.
So Sagimet is just a fraction of the size of these direct competitors.
A tiny fraction. That massive valuation gap is the crux of the investment question, isn't it? Does it mean the market thinks Sagimet's approach is way riskier or less likely to succeed, or is it potentially deeply undervalued?
That's a multi-billion-dollar question, literally.
Yeah, it really is. And navigating that regulatory pathway for MSH is tough. But like we said, that breakthrough therapy designation is a real leg up for Sagimet.
Smooths the path a bit.
Hopefully. Plus, the shift towards using non-invasive biomarkers like certain MRI scans might make trials a bit easier down the line.
What about barriers to entry? It sounds incredibly expensive and risky to even try.
Formidable barriers. You need hundreds of millions, potentially billions for R&D. The clinical and scientific risk is immense. The failure rate for drugs, especially in complex diseases like MH, is brutally high.
But Sagimet has some protection. Intellectual property.
Yeah, they seem to have built a solid IP fortress. Around 115 patent documents, including 85 granted patents covering their FASN inhibitor platform. That's a crucial competitive moat.
And their brand strength. How do you even measure that for a pre-commercial biotech?
It's not about TV ads, obviously. It's about credibility within the scientific and medical communities.
Right, presentations at conferences.
Exactly. They've consistently presented positive data at major liver meetings like ESL and MASH-specific ones like MASH-TAG. That builds reputation among the doctors who might eventually prescribe the drug.
So their key competitive advantages are that proprietary FASN platform, the compelling phase 2B data, and that FDA breakthrough tag.
Those are the tangible assets, yes. Validated, at least to this stage, by the data and the regulators.
Okay, we've got a good handle on the science and the market. Let's turn to the people in charge. That brings us to Chapter 2, Management Evaluation. Who's steering the ship at Sagimet?
The CEO is David Happel. He came on board in October 2022. Seems like a strategic hire, really, timed for late-stage development.
What's his background? Any big wins?
Yeah.
Or, any notable setbacks?
His background is pretty impressive. At a previous company, Cognoa, he actually secured the first ever FDA authorization for an AI-based device for diagnosing autism. That's quite something.
Wow, yeah. First ever FDA nod for AI in that space is significant.
Definitely. Plus, he has extensive commercial experience from established pharma companies, Horizon Therapeutics, Raptor, Chiron. Solid background.
Any flags? You mentioned chronotherapeutics failure in the outline.
Yeah, there was a previous venture, Chronotherapeutics, that didn't succeed, but honestly, in biotech, that's almost par for the course.
Great. Failure is common. Doesn't necessarily mean the leader can't execute.
Exactly. One failure doesn't erase the successes, especially a unique win like the Cognoa FDA authorization. It's more about resilience, learning from it.
And the rest of the team, the board.
It's a seasoned group overall. Lots of experience from big biopharma names Amgen, AbbVie, Gilead, Novo Nordisk, people who've been there, done that.
Any standouts on the board?
Well, Tim Walbert is notable. He built Horizon Therapeutics basically from scratch into a company Amgen bought for $28 billion. Having that kind of experience guiding strategy is invaluable.
Definitely. And how are they on transparency and communication?
They seem pretty solid. Regular press releases, timely SEC filings, they show up at investor conferences. Their communication appears data-driven, and they seem pretty candid about the risks and, crucially, their ongoing need for funding.
They have a code of ethics publicly available too, right?
Yep, Code of Business Conduct and Ethics is out there. Standard stuff, but good practice.
Okay, management sounds experienced. Now let's connect that to the money. Chapter 3. Financial analysis. How are they actually using their capital?
Well, for a company like Sagimet, it's pretty straightforward. Nearly everything gets plowed back into R&D.
Research and development. Makes sense.
Yeah, their R&D spend almost doubled from about $20 million in 2023 to over $38 million in 2024.
That's a big jump, but necessary for phase 3.
Absolutely necessary. Phase 3 trials are exponentially more expensive than earlier stages. That increase is actually expected, even required, if they want to advance denifanstat.
Have they done any acquisitions? Or are they more likely to be acquired?
No history of acquiring companies themselves. But that Ascletis deal, the out-licensing one, that was a smart move for non-dilutive cash and sharing the risk.
Yeah, the acquisition question is interesting.
Very interesting. Sagimet is definitely viewed as a potential acquisition target. Management themselves have said they're exploring various alternatives to fund denifanstat development. A sale is certainly one of those alternatives.
Right. What about things like share buybacks or dividends? Common for mature companies, but here.
Absolutely none. And that's completely normal and appropriate for a cash-burning clinical stage biotech. Every single dollar has to go towards getting that drug approved.
So what does that mean for their return on invested capital, ROIC?
Oh, it's deeply negative, like negative 41% on a trailing 12-month basis.
Minus 41%. Sounds awful, but expected.
Totally expected. You can't calculate a meaningful positive ROIC when you have no real revenue and massive R&D investment. The entire investment thesis here is based on the potential future ROIC years down the line if they get a blockbuster drug approved and commercialized.
Right. The payoff comes much later, if at all. Okay, let's hit some key financial metrics. Market cap, we mentioned, around $266 million. Tiny compared to those MEHH peers.
That valuation gap is really the headline number, yeah. Compared to Madrigal at $6.5 billion, it's stark.
Revenue growth trends, you said, basically not meaningful.
Not meaningful at all right now. That $2 million in 2023, but zero in 2022 and 2024 TTM. Investors should be laser-focused on clinical data and regulatory news, not past revenue blips.
Profit margins must be terrible then.
Deeply negative across the board, gross, operating, net. They had a $54 million operating loss in 2024 on zero revenue. The metric that matters more here is the cash burn rate.
And how's that looking? Free cash flow.
Consistently negative and increasing. It went from about negative $10 million back in 2020 to over negative $41 million in 2024.
That jump in 2024, again linked to phase 3 costs.
Correctly. Advancing denifanstat is eating up cash, as it must.
Okay, so they're burning cash, consistently losing money on paper. How stable are they financially then? This sounds precarious.
Well, the net losses are consistent, yes. Around $45 million loss in 2024. But here's the surprising strength. Their debt.
They don't have much.
They have virtually no debt. The debt-to-equity ratio is basically zero, just tiny amounts, like $39,000 total.
Wow. For a biotech needing cash, having no debt is a huge advantage.
Tremendous flexibility. It makes raising future funds, whether equity or maybe even debt down the line, much easier, and it gives them operational breathing room.
What about their short-term liquidity, current ratio?
Exceptionally strong. The current ratio is over 20x, 20.26 to be exact.
20. That means they have 20 times more current assets, mostly cash from those stock offerings, than short-term liabilities.
Exactly. It shows a really healthy operational runway, at least for the near term, based on the cash they have on hand right now.
Okay, so runway looks decent for now, despite the burn. Dividends, obviously not applicable.
Nope. No dividends paid or planned.
All right, let's talk valuation. This is tricky for a company like this. Standard metrics like PE are useless.
Useless with negative earnings, yeah. Price to book is around 2.0x, but even that's limited because the real value isn't in tangible book assets. It's in the intangibles.
The intellectual property, the clinical data, the potential of the pipeline.
Precisely. So you can't really use traditional relative valuation metrics effectively. You need something else.
Which brings us to that model you mentioned earlier, the RNPV.
Right, the risk-adjusted net present value, or RNTV model. It's a common way analysts try to value clinical stage biotechs.
Can you break down how that works again, simply? The lottery ticket analogy was good.
Yeah, okay. So you project the potential future cash flows if the drug is successful. Peak sales, costs, profits over many years. That's the jackpot.
Okay.
But then you have to apply a probability of success factor, the odds of winning. This is based on historical data for similar drugs at similar stages, adjusted for the specific company's data, like Sagimet's positive phase 2B and breakthrough status.
So you heavily discount those potential future billions based on the chance it might fail.
Exactly. You risk adjust those cash flows. Then you discount those risk-adjusted flows back to today's value using a high discount rate to account for the time value of money and the inherent riskiness of biotech.
Makes sense. So running the numbers for denifanstat and MASH using this RNPV approach,
Yeah.
what kind of value does the model spit out?
Well, keeping in mind this is an educational model and involves many assumptions. The estimated intrinsic value range comes out somewhere between $15 and $35 per share.
$15 to $35 per share. That's
yeah.
a pretty wide range.
It has to be. It reflects the huge uncertainty. Small changes in assumptions about success probability, market share, or pricing can swing the value wildly.
And what are the key assumptions driving that $15 to $35 range in this model?
Okay, so it's focused on MASH F2, F3 fibrosis, assumes peak market penetration somewhere between 10% and 15%, fairly conservative given the competition.
Okay.
A hypothetical annual gross price around $20,000, kind of in line with similar specialty drugs. The probability of success used is between 60% and 70%.
That seems high compared to typical biotech odds. Why?
It's adjusted upward from the historical average because of the positive phase 2B data, that FDA breakthrough therapy designation, and also the positive acne trial data, which helps validate the underlying FASN platform technology.
Got it. And the discount rate?
High.
Right.
Between 15% and 20%, that reflects the significant risk still involved in clinical stage biotech investing and a standard 2% terminal growth rate after patents expire.
Okay, that paints a picture. It suggests, based on these assumptions, the current price, around $8.72, might be significantly undervalued if things go right.
If being the operative word. But yes, that's what the model suggests.
Right. Let's pause there. That covers the core business, the management, and the financials. A lot to digest.
Definitely.
When we come back for part 2, we'll look at how the market perceives Sagimet in Chapter 4. Market sentiment, dig into who owns it in Chapter 5. Ownership structure, face the risks head-on in Chapter 6. Risk assessment, and then pull it all together in Chapter 7. Conclusion. Stay tuned. Welcome back to the Deep Dive. We are diving into part 2 of our look at Sagimet Biosciences. Let's kick off with Chapter 4. Market sentiment. How is Wall Street feeling about SGMT right now?
Overwhelmingly positive, at least based on analyst ratings. The consensus is a strong buy.
Strong buy. And the price targets.
The average 12-month analyst price target is sitting around $30.40.
$30.40 compared to the current price of $8.72. That's huge potential upside they're seeing, over 240%.
It is, though the targets themselves range quite a bit, from about $11 on the low end to over $70 on the high end. You've got firms like Jones Trading, H.C. Wainwright, Oppenheimer, even Goldman Sachs and Piper Sandler with positive ratings recently.
So what's driving all this bullishness from the analysts?
It's really been fueled by a string of positive news catalysts over the past year or so.
Like what?
Well, most recently, the positive phase 3 acne data that came from their partner Ascletis in China just in June 2025, that helped validate the whole FASN platform approach.
Ah, cross-validation from another indication.
Yeah.
Smart.
Then you had the FDA Breakthrough Therapy designation back in October 2024. That was big.
It's huge.
And before that, the positive phase 2b Fascinate 2 results for MASH back in January 2024. All these things created real positive momentum in the stock price.
Okay, so analysts are bullish, news flow is positive. But here's the twist. The short interest is really high, isn't it?
Very high. 15.86% of the float was sold short as of the latest data. That's significant.
15.86%. So what does that mean? It's a battleground stock.
Absolutely. You've got the bulls, represented by the analysts and long-term investors, betting on the science and the market opportunity. And then you've got the bears, the short sellers, betting against it, likely focused on the risks, clinical failure, financing needs, competition.
And this creates potential for extreme volatility.
Exactly. If more good news hits, especially positive phase 3 data, you could see a massive short squeeze. Shorts rushing to buy shares to cover their losing bets, driving the price up even faster.
But the flip side.
The flip side is, if there's bad news, a trial failure, a regulatory setback, the shorts are proven right, and the stock could fall very sharply as longs sell and shorts press their bets. It makes for a very jumpy ride.
Let's look at some technical market indicators. How's the price relative to its moving averages?
Pretty strong, actually. The current price, $8.72, is way above its 50-day simple moving average, which is down around $3.94.
Okay, so strong short to medium term momentum.
Yep. And it's also well above its 200-day SMA, which is around $4.24. That confirms a more sustained uptrend.
And you mentioned the 50-day is above the 200-day. That's the golden cross thing.
That's the one. Technical analysts see that as a very bullish signal. It suggests the recent positive momentum is strong enough to pull the longer-term trend higher, often indicating more upside ahead. Technically, it looks good.
All right, so market sentiment is positive but contested, with technicals looking strong. Let's move to Chapter 5, ownership structure. Who actually owns SGMT stock? Is it hedge funds, individuals, insiders?
There's significant institutional ownership. About 45%, almost half the company, was held by professional money managers as of the end of March 2025.
44.92% to be exact. Any notable names in there? The smart money.
Yeah, that's the interesting part. You see specialist healthcare funds and well-known managers in the mix. Names like Point72 Asset Management, Blue Owl Capital, Alyeska Investment Group, Baker Bros, Advisors, Rock Springs Capital.
Baker Brothers, Point72. Those are big names in biotech investing.
They are. Their presence suggests high conviction from investors who presumably do very deep scientific and financial diligence.
Have they been buying or selling recently?
It's been a bit mixed. You see some trimming, which could just be profit-taking after the run-up, but the key is that many still hold substantial positions. They haven't all run for the exits.
What about insiders, management, and board members?
Insider ownership is also quite high. Estimates vary, but somewhere between roughly 7% and maybe even up to 25% depending on how you count.
In any insider buying, that's usually a strong signal.
Yes, and a very important one. CEO David Happel himself made open market purchases of the stock back in March 2024.
The CEO buying shares on the open market with his own money. That's about as bullish an internal signal as you can get.
It really is. Now, you do see some sales from other officers, but those are often under prearranged 10b5-1 plans.
Right, those scheduled plans for diversification, not necessarily a negative signal.
Correct. You also see share grants as part of their compensation, which is standard, but the CEO buying is the key takeaway there.
So overall, the ownership is relatively concentrated among these institutions and insiders.
It seems that way, yeah. Which can, as we said, increase volatility if a big fund decides to sell a large chunk.
But it also means the people with the most skin in the game, who are hopefully the most informed, have significant influence over the company's direction.
That's the positive angle on it, yes. Governance is likely influenced by knowledgeable, long-term oriented investors.
Okay, now for the really crucial part. We know the potential upside, but we need to stare the risks right in the face. Chapter 6, Risk Assessment. Let's use a SWOT analysis framework. Strengths first.
All right. Key strengths. Denifanstat, the lead drug, has that promising phase 2b data. The scientific platform, FASN Innovation, has been validated, or at least de-risked, by the positive acne phase 3 data from Ascletis.
Plus the breakthrough therapy designation.
Crucial, experienced leadership team. And surprisingly solid near-term financials, that high current ratio, very low debt. Those are real strengths.
Okay, weaknesses. What are the internal vulnerabilities?
Number one is absolute financial dependence. They are pre-revenue, they need more cash, likely significant amounts, to fund phase 3 trials and beyond.
Which leads to a high cash burn rate.
High and accelerating due to those phase 3 costs. There's also significant asset concentration risk. The company's fate is overwhelmingly tied to denifanstat succeeding in MAH.
And just being small is a weakness in itself compared to big pharma.
Lack of scale, lack of a diversified pipeline, yeah. Classic small biotech weaknesses.
Now, opportunities. What external factors could really boost Sagimet?
The sheer size of the M&Ish market is the biggest opportunity. That potential $90–100 billion market represents a massive unmet medical need.
The pipeline in a pill idea.
Right. The potential for their FASN platform to work in other indications, like the acne data suggests, maybe even cancer down the line, that diversifies opportunity.
Combination therapies. Using denifanstat with other drugs.
Yes, potentially. Denifanstat's mechanism might be synergistic with other MAH drugs like Madrigal's Resdifra that could expand its use. And of course, the big opportunity is a strategic partnership or an outright acquisition by a larger pharma company looking to get into MAH shape.
They seem like a prime target if phase 3 looks good.
Absolutely. Okay, now for the threats. The external dangers.
What keeps management and investors up at night?
The biggest and most significant threat, the existential one, is clinical trial failure. If denifanstat fails in phase 3, the impact on the stock would likely be devastating. It's a binary risk.
The MAH trials have a history of failure too, right?
They do. It's a complex disease, hard to treat. Beyond trial failure, there are regulatory hurdles. The FDA might demand more data or ultimately not approve it. Competition is fierce and getting fiercer. And even if approved, getting market access and favorable reimbursement from payers is another major challenge.
What are broader macroeconomic threats?
Elevated interest rates are a big one. They make borrowing money more expensive, and they make equity financing, selling more stock, more dilutive, and potentially harder to do. Higher rates also tend to make the whole biotech sector less attractive to generalist investors.
And inflation. The Inflation Reduction Act.
Inflation drives up clinical trial costs, and the IRA includes that so-called pill penalty. It means small molecule drugs like denifanstat face government price negotiations after 9 years on the market compared to 13 years for biologic drugs. That shortens the window for peak profitability.
Okay, any specific geopolitical risks?
Well, the relationship with Ascletis and China is important. Any significant escalation in U.S.-China trade tensions, potentially leading to new tariffs or restrictions like those discussed for 2025, could theoretically disrupt that partnership, impacting capital flow or data sharing. It's something to watch.
All right, that covers the SWOT. Let's bring it all home now. Chapter 7, Conclusion. Synthesizing everything we've discussed, what's the bull case versus the bear case in a nutshell?
Okay, the bull case. Sagimet has a differentiated drug, denifanstat, targeting a massive market. It has compelling phase 2b data, that valuable FDA breakthrough tag, and a platform technology de-risked by success in another indication, acne. It's led by experienced people, backed by smart money investors, the CEO is buying stock, and it trades at a steep discount to its peers. That's the bull story.
And the bear case.
The bear case. Sagimet is a pre-revenue, cash-burning company totally dependent on one key asset. It faces significant financing risk to fund costly phase 3 trials, especially in a tough macro environment, which could mean painful dilution for shareholders. Clinical trial failure is a very real, potentially catastrophic risk, especially in the MAH graveyard. Competition is intense, and that high short interest shows a lot of market skepticism is still baked in.
So revisiting that valuation model, the RNPV.
Right. Our educational RNPV model estimated that intrinsic value range of $15 to $35 per share.
And the stock is trading at $8.72 as of June 20, 2025.
Exactly. So the current price is well below even the low end of that model's range.
Which implies the market is pricing in a lot of that risk we just discussed.
Precisely. That discount reflects the uncertainty around the binary phase 3 outcome, the financing overhang, the competitive landscape. It fully captures the high-risk nature of this investment.
So the bottom line is, this is a classic high-risk, potentially high-reward biotech play. Your view on it really depends on how likely you think denifanstat is to succeed in phase 3 and get approved.
That's exactly it. The path forward will undoubtedly be volatile. The company's future hinges almost entirely on the clinical data yet to come.
A real nail-biter ahead for investors. So here's a final thought for you, our listener. As Sagimet navigates these incredibly high stakes, what specific piece of news or data, maybe interim phase 3 results, a financing deal, a competitor's update, what would make you feel significantly more confident or perhaps more concerned about its future? Something to ponder.
Good question.
And before we sign off, please don't forget to like and subscribe to Stock Analytics AI. Remember, members get priority deep dives and access to our upcoming S&P 500 coverage. Join the community.
And finally, the important disclaimer. This analysis was generated by an AI system. It's for educational purposes only. It is absolutely not financial advice. Please always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Couldn't have said it better myself. Thanks for tuning in to The Deep Dive.